Welcome back to the chapter fourth part. So now we're going to talk about the statement of a cash flow, right? So we have finished talk about the statement of net income. So first of all, when a balance sheet and an income statement are presented, a statement of cash flow is required, okay, for each period that you present in these two sheets, okay. And this is because the statement of cash flow is to providing information about the cash receipts and cash disbursement of an enterprise. And similar to the income statement, right? It is a change statement, means that it's a statement that analogies a video that you know what it was before and then you know what is now, right? It's not like a balance sheet, it's like a photo. You only know as of that moment what it looks like. And the cash term in the cash flow statement, this cash, it stands for the cash and cash equivalent and the restricted cashes, right? And then we discussed the difference between the cash and the accrual accounting in chapter 1. And it was pointed out that and illustrated that over a short period of time, operating cash flow may not be indicative of a company's long-run cash generating ability, and that accrued based net income providing a more accurate prediction of future cash flow profitability, right? But still, the information about cash from other activities and operating activities, when combined with the information from investing and when the information about the cash from operating combined with investing and financing, it can assessing futures the profitability, liquidity, and long-term solvency. Because in the end, we combine this information, it is really helpful in assessing whether a company can pay its debt, because debt is paid by cash, right? In the end, no matter what kind of information you're talking about. And another particular importance of amount of cash generating of operating activity is because in the long run, a company must be able to generating a positive cash flow for activities related to your main business, right? This activity must provide necessary cash to engine the paying the debt, providing dividends, and providing future growth. So therefore, a detailed description about what's the cash receipts and outflow payments about the operating, investing, and financing activity is very important to the information user, right? So which following is true concerning statement of cash flow, right? A, the statement of cash flow can provide information helpful assessing the profitability, liquidity, and the solvency. And B, the statement of cash flow shows cash receipts and disbursement of enterprise. Yes, that's right too. And C, the statement of cash flow is required being presenting for any period for which income statement is present. So that's right. So D is the accurate answer. Okay, and then let's first of all look at what is operating activity in the cash flow statement. It refers to the inflow and outflow of cash that results from the activity reporting net income statements, right? Such as the cash inflow stands for the sale of the goods or services, and or the interest and dividends from the investments. And the cash outflow stands for the purchase of inventory, salaries, wages, and other operating income, and the interest paid on the debt and the interest income taxes as well. And the net cash flow of operating income is simply cash inflow minus cash outflow, right? So these amounts may be differ, right? So the months, so when you find out the cash inflow and outflows, those number should be almost the same, almost 100% time is different from the net income number that you provided in the income statement, right? When the net cash flow you calculated. For example, sales revenue maybe is because the net income when the sales revenue it was measured based on accrual based. Yeah. So and then reflects the revenue recognized during the period, not necessarily has collecting the cash yet, right? So revenue will not equals the cash collected from the customer if receivable from customers or deferred revenue generated. Hence, that the cash inflow would not usually equals the revenue number. So does the cash outflow is not always gonna equals the expense, right? So therefore, the net income number might not equals the net cash flow, right? So this is the difference between accrual accounting and cash accounting. Okay, and then let's look at how we prepare cash flow statements. And then there's a two generally accepted format can be used. First, we call it direct method, and this is should be covered in the financial accounting class. And then another one called the indirect method, right? So in terms of the direct method, it's look at the cash effects of each operating activities reported directly in the statements, right? And another one called the net cash flow is derived indirectly by starting with the reported net income and working backwards towards to converting that amount to a cash base. In other words, in the direct method, right, the cash effect of each operating activity is reported directly in the statement, meaning that if you see cash inflow, you just record it. If you see cash outflow, you record it. You don't follow whether this is gonna be a revenue or whatever. If you see in, so you just denote it, okay, inflow, and at most you just differentiate between is this items investing, is this items financing, is this items operating, right? But under the indirect method, if you remember, majority 90% of people using indirect method because direct method is very expensive because you pretty much need to have a new accounting system to track the cash in and out from each activity, right? But the indirect method is to starting with reporting net income and work backwards towards the cash basis accounting. So in other words, we can arrive net cash flow from operating activity indirectly by starting with reported net income. So for example, the components of net income that do not affecting operating cash flow are reversed, right? That means that, for example, non-cash revenues, right, and gains are reversed, while non-cash expenses or losses are added, right? Because remember, in the net incomes, those non-cash revenues and gains are actually positive towards net income, right? And those non-cash and expenses and losses are negative towards net income. But think about if you are reporting cash, because those are non-cash forms, so those income and revenues should be subtracted because it does not creating inflow, right? And then when you see those deducted or subtracted items in terms of net income, and then you find that's non-cash related, so you have to add it back, right? So, and the net income is adjusting for, and another adjustment, remember this is the first kind of adjustment. Second adjustment is adjust for the changing of current asset or changing of current liability. This is because the change representing amounts that are included as a component of net income, but that is not cash flow, right? For instance, suppose accounts receivable increases during the period because revenue from credit sale is greater than the cash collected from customers. This increase in accounts receivable, right, such as accounts receivable, represents would then be subtracted from the net income, right, to arrive cash flow from operating activity. In the direct method, the positive adjustment to net income are made for decreases in related assets and increases in related liability. In other words, if you have increases in the changing of current asset and decreases in current liability, you have to subtracting it from net income to arrive the cash flows, operating cash flow. But if you have a decreasing of a current asset and the increasing in current liability, then you have to add back to net income. Okay, so this is things that we covered in financial accounting, but we can do a more deeper review of it. So we wanted to presenting the contrasting the direct versus indirect method of cash flow from operating activity. For example, this is a direct method, right? So this operating expenses, and then look at this depreciation expenses, and so this expenses is non-cash, right? Related. So this is income statement, and let's see. From this income statement, we find that there's 4 components. 3 of those, such as the service revenue, right, and the general administration and expenses and income taxes. Okay, so hold on a sec. So the service revenue, general administrative expenses and income expenses, this does reflecting cash. Those 3 items affect the cash. But like I said earlier, this one, depreciation expenses, there's a depreciation expenses does not affecting cash, right? And to report this operating activity on cash base rather than accrue base, we take 3 items that affecting cash and adjusting their amounts to reflecting cash inflow rather than revenue earned, and cash outflow rather than expenses incurred, right? So therefore, as you can see, the direct method cash inflow from operating activity received from the customer, say the service revenue was reported as 100,000 right here, but this is not every penny, not every dollar is collected, right? So therefore, in order to representing cash, then you have to minus those dollars are not collected yet, right? So let's see here. Service revenue for 100,000 less the increasing of $12,000 in accounts receivable. Why is less that? Because the increasing accounts receivable means that the $100,000, there's a 12,000 having collected. So therefore, the real cash received from customers only 88,000, right? Okay. So look at the general and administration expenses. In terms of general administration expenses, it was, as you can see, it was a 32 here. But in terms of cash related activity, we have to reduce the $7,000 accrued liability plus increase in $4,000 in prepaid insurance. In other words, this number should be 32 minus 7 plus 4, which is equals 29, right? The reason is that this 32,000 expenses incurred, right? So let's go back to here. This $32 incurred expenses, not every dollar is paid yet. So therefore, if you have if you have expenses hasn't paid, then therefore you have generating accounts payable, right? So therefore, those dollars that are not being paid yet is not a cash outflow, right? So therefore, $7,000 in terms of the activity accrued liability means that increase. So 32 minus 7. But why we have to increasing plus 4 is because there's a $4,000 was paid in terms of prepaid insurance, because in this items here, right, general administrative expenses, we were not including $4,000 for prepaid in here because it's not accrual accounting, because those 4,000 increase in the prepaid expenses is considered as assets, right? But not in the cash-based accounting. Cash-based will consider this 4,000 prepaid insurance as cash outflow. So therefore, you will have a cash outflow for 29, right? Okay, so let's look at the income taxes, right? So income taxes is reporting the expenses as a 15,000, but here we only paid 10,000 because there's a 5,000 is still not paid yet. It be recorded as income tax payables. So therefore, using direct method, we translated the cash flow from operating activity as a 49. So in other words, we have a revenue. So in another word, the revenue instead of 100, we reported 88 because we only collected the cash for 88 because this is account receivable account, right? We collect the 88,000 cash, and we are really outflowed for 29,000 to pay the G&A expenses, and we paid 10,000 to income taxes. But if we use indirect method to do it, the first thing is that we put the 45,000 from the income statement. We start with this number, and then we were adding back the non-cash expenses. We will add non-cash expenses back, right? And also we will minus the increasing of accounts receivable. We will minus the increasing in assets, right, which is a prepaid expense. We will we were decreasing. Oh, sorry. We were minus the increasing in accounts receivable. Yes. So hold on a second. Yeah, we were minus increasing accounts receivable. We were minus increasing in prepaid expenses, right? Because we minus increasing accounts receivable because this portion of of revenue has not been generated in cash format, and then we will minus the increase in the prepaid insurance because this insurance expenses is asset, and then there's a cash outflow to creating this asset, right? At the same time, we will plus the increase in accrued liability because by borrowing money we save the cash, right? We save the cash. We were supposed to pay $7,000 cash, but we didn't. We park under the liability, current liability, and then we will also similarly we will plus the increased tax payables because we were supposed to pay the tax and we didn't, right? Hence that it saved the cash for $5,000. So therefore, the changing in operating asset and liability ends up with 4. Hence that the net cash flow it should be a 49. So in total, no matter which method you use, in the end, the net cash from operating activity should be total at 49. Okay. So now let's look at the investing activity. So investing activity of cash flow, sorry. So it's the inflows and outflows of cash related to the acquisition and disposition of long-lived asset used in the operation of the business or investment assets, right? So purchasing and sale of inventory is not considered as investing activity. And in terms of a cash outflow, for specific example such as the purchase of long-lived asset used in the business, or purchase of investment security like stocks and bonds of other entity, or loans to the other entities as well. And cash outflows in terms of investing activity is the sale of long-lived asset. And I wanted to give you attention here just for 1 second. So loans to other entity means that you are the borrower, you are the lender, right? So you're lending money to other entities. So therefore, you consider the interest revenue as investment return, right? And then later on, you will see the financing activities. The inflow it's in here, as it also you can see it's a cash outflow because you're giving people, you're loaning people money. So therefore, it's considered as an investing activity, but it's a cash outflow. And then specifically, let's look at the inflows of investing activities, such as you sold your long-lived assets used in business, or you sold your investment securities, or you collecting non-trade receivables, such as the loans that you're lending to other people. But I wanted to say that please remember, excluding the collection of interest, which is operating activities, okay? And then in terms of financing activities, it's related to the cash inflow and outflow of cash related to external financing of the company. Like first chapter, I mentioned that it's related only to parties. Simply put, either one is owners, means the stockholders, or creditors, right? So the cash inflows related to owners when the shares are sold to them, right? And the from creditors, you have a cash inflow when the cash is borrowed and through the notes and loans and mortgages and bonds that you owe, right? You are the borrower here. You go borrow money, and then when they approve your loan, they deposit the cash into your bank account. So therefore, those are cash inflow from financing activity. And cash outflow from financing activity is related to the owners in the form of the dividend or other distribution. Also, to owners for the reacquisition of the shares previously sold, like a treasury stock, or to the creditors as a repayment of the principal amount. I cannot stress enough. This in the CPA firm, CPA exams, they often ask you what kind of cash outflows is gonna be in terms of operating or financing. They usually ask you the payment of a principal amount of debt. The principal amount of the debt is belonging to financing activity. The payment of the interests, okay, is belonging to operating cash flow, okay? Okay, so this will be an example of what it look like a cash flow statement. So cash flow from operating activity is 49,000. Cash flow from investing activity is due to purchase of equipment, hence its outflow of 40,000. And cash flow from financing activity, the inflows related to new issuance of common stocks, the dividend payment to the shareholder related to the outflow. Has net cash flow from the financing activity is 45,000. So the net increasing in cash is in adding these three numbers together. So you're getting 54,000. And then since the beginning of the period was a zero cash, hence the ending cash balance should equals the 54,000, and this should equals the balance sheet cash balance. Okay, this should be the same. And then also there's items called non-cash investing and financing activities, and these activities that do not involve cash flow at all, and then they are reporting in the face-off statement of cash flows or in a disclosure notes. So I want to give a little bit description what is no cash investing and financing. So for example, there are many significant investing and financing activity occur during a period that do not involve cash. In order to provide the complete information about those financing and investing activities, any significant non-cash investing and financing activities, such as non-cash exchange, are reported either on the face of cash flow statement or in a disclosure. A good example is the acquisition of equipment, which is considered as an investing activity by simultaneously issue a long-term debt payable or issue equity to buy this equipment. It does not involve cash, but you have to disclose these two similar financing activity or investing activity in the cash flow statement notes section. Okay, so let's look at check the concepts. Which of the following items would not be included as a cash flow from operating activity? A. Purchase of equipment, inventory. Yes, this is operating. B. Purchase of machinery. So B is correct, right? Because machinery is long-term asset, right? And used in the business. Hence, that B is accurate. And concept check 2. Let's calculate this. So Bledsoe Models reported a revenue of 7.5 million for its year ending in 2021. Accounts receivable at end of year 20 and year 2021 were 480,000 and 532,000 respectively. Using direct method for reporting cash flow from operating activities, Bledsoe's model would report a cash collected from customers. So in other words, I believe you can ignore this. It should be how do we figure out how much the cash collected from customers for this model company, right? So we know that the revenue is 7,500,000, right? But this revenue, it has using cash collected portion and the non-cash portion, right? So how do we calculate the non-cash portion? Non-cash portion is related to the increase of accounts receivable, right? And how much is the increase of accounts receivable? Is the 532,500 minus 480,000, and then this will give us 502 and 3,500, right? So yes, so we have a increasing of 52,500 accounts receivables, right? And this amount is non-cash portion. Hence, that the cash collected portion for the direct method is gonna be 7.5 million minus 52,500. It will give us 7,447,500. So therefore, it should be D. Okay. So another example is Greengler Pastries reported net income of 432,000 for its year ending in December 31st, 2021. Purchase of merchandise totaled of 304,000. Accounts payable balances at the beginning and ending of the year were 72,000 and 66,000 respectively, right? So first of all, it has a reported net income, and then it also tells you that the purchase of inventory is 304,000, and then told you that the accounts payable decreases as well, right? Decreases. So beginning and ending inventory balances was 88,000 and 92,000. Assume all relevant information has been presented. Greengular Pastry would report operating cash flow as how much? So in this case, that is an indirect method, right? Because they give us the net income number. So we start with net income for 432,000. And then does this purchase of a merchandise total of the 304 relevant? In this case, it's not relevant. The reason is we already was given the information about the beginning and ending inventory, which is gonna be mingled with the 304,000 calculations, right? So basically, it was 72,000, right? And then it's an increase in the 304,000, and then it sold something, and then and its ending was 92,000, right? So in our calculation, we know that to translating the cash flow of operating cash flow statement, we just need adding the decrease, we need to add the so we need the minus the increasing in current asset. Okay. In current asset, we need a minus the decrease in current liability. So therefore, the current asset, which in this case is inventory, right? So the inventory increases from 88,000 to 92,000. So it's increased of $4,000. So we're gonna minus this $4,000. And then the accounts payable, which is a current liability, it's a decrease for 72 from 72 to 66,000. So the decrease is 6,000. So therefore, if you use 432,000 minus 4,000 minus 6,000, you are getting 422,000. So the answer is C. Okay. So now I just want to give you a brief comparison between the IFRS and GAAP in terms of classification of cash flow. So IFRS also requires statement of cash flow when the with operating and financing classification. And the biggest difference is in the presentation of how do IFRS and treated the interest expenses or interest revenue and dividend payment or dividend recipients. As you can see in US GAAP, it's very clear that dividend received, interest received or paid are all considering as operating activity. Only dividend paid is considered as a financing activity. However, in IFRS, it's much more flexible, right? In another word, interest paid can be considered as operating or financing activity. Dividend paid, okay, it can be considered as operating or financing activity, right? However, in terms of the dividend and interest received, both of them can be considered in operating and investing activities. So there, in another word, IFRS in terms of a categorization between the financing, operating, and investing activity cash flow presentation is much more flexible. Okay, so let's look at this multiple choices. So which of following is accurate concerning the presentation of financial statements in regard to IFRS compliance? A. Unlike a US GAAP, IFRS require minimum information to be disclosed on face of income statement. That's true, right? They have a specific requirement that you got to disclose revenue, expenses, major category of revenue, expenses, and gains and losses. And the US GAAP does not have the minimum requirement. And B. US GAAP and IFRS displays interest and dividend differently on statement of cash flow. That's true, right? So we say that only in GAAP, only dividend paid is supposed to belong to the financing activity. Other than that, interest either receive or give is all under the operating activity, right? And dividend distribution, dividend recipients under operating. But IFRS it can be all over the place, right? So C, both US GAAP and IFRS allow company to report the comprehensive income as a single statement or two separate statements. Yes. So D is correct. So now we are going to the profitability analysis. So basically, this is a review section of financial accounting about financial ratio analysis. Okay, it's important that we know how to use the financial statement to conducting financial statement analysis. First of all, Chapter 3 providing an overview of financial analysis already, right? And introduce some of common ratios used in the risk and solvency risk analysis to investing investigate the liquidity and the solvency ratio, right? And in this chapter, we're going to talk about the profitability ratios, and then usually profitability is it meant how well a company has managing and utilized its assets, right? The higher these three ratio, the fewer assets are required to maintain a level of activity, right? Such as the asset turnover ratio. It means that for $1 of asset, how much sales did you generate? So this ratio is computed by dividing the net sales by the average total assets, and average total assets calculating as beginning assets, right, plus ending assets, and dividing the two. And so the asset turnover ratio providing an indication of how efficiently a company is utilizing all its resources to generating revenue. And in terms of receivable turnover ratio, the numerator still is net assets, but the denominator become average accounts receivable, right? In terms of this ratio, receivable turnover ratio is an indication of a company's efficiency in collecting the cash from a customer, right? And this ratio shows the number of times during a period that the average accounts receivable balances is collected. And the higher the ratio, the shorter the average time that needs to be collected cash from the customer. And the inventory ratio is how fast the inventory is being sold, right? So I will talk about these two ratios in detail. So first of all, average collection period is an extension of receivable turnover ratio. It shows approximately how many days the average accounts receivable balance is outstanding, right? So basically use a 365 days divided receivable turnover ratio. It indicates the average age of accounts receivable. Monitoring receivable turnover ratio or average collection periods over time can provide very powerful information about the company's future perspective, right? This is because a declining in receivable turnover ratio, we're indicating the average collection period increases, right? So and the reason such decline in the receivable turnover ratio could be an indication that the sales are declining because the customers are dissatisfaction with the company's product. Another possible explanation is that company has changing its credit policy to retain the customers. So therefore, it needs longer time to collecting the revenues. So either explanation would be a signal, right? If you find that the average collection period is high or receivable turnover ratio is low, It signals to the investor a future increase in the bad debt, right? Because either you cannot attracting enough customer or you extending your credit policy, they're all gonna trigger bad debt increases in the future. Hence, that the ratio analysis does not explain what is wrong. It can provide the information to highlight the areas of future investigation. And in terms of inventory turnover ratio, it shows of a number of times the average inventory balances is sold during the period, right? And also it indicates how quickly inventory is sold. Basically, first of all, if you want to calculating the ratio, you use the cost of goods sold dividing average inventory. If you wanted to calculate how many days that inventory is in the warehouse, you use 365 days dividing inventory turnover ratio. A relatively high inventory turnover ratio, say compared to the company's competitor, right, is usually very desirable because high ratio indicate the comparative strength, perhaps caused by a company's superior sales force or maybe successful advertising campaign. However, it might also be because a relatively low inventory level. It could mean that either efficiently managing the inventory, or it could indicating potential loss of sales in the future because you have too low stocks, right? On the other hand, if a relatively low ratio, this is low, or decreasing in the ratio over time, is usually perceived as very unfavorable because too much capital has been tied in the inventory, right? And it may end up result in overstocking, presents potential of obsolete and poor marketing and sales efforts. And another thing we want to look at is the profitability analysis. Is attempts to measure company's ability to earn adequate return relative to the sales or resources being devoted to the operation. So the first thing we wanted to talk about is profit margin, which we use the net income dividing net sales. And the second ratio we wanted to talk about is the return on asset, is using net income dividing the average of total assets. And the last one we're going to talk about is return on equity, is net income dividing average shareholders equity, right? So first of all, the profit margin is simply it indicates the portion of each dollar, right, of the sales, how much is available after all expenses are covered, right? So for example, if you sell $10 and then you have a profit margin of 3, so that means that after cover all expenses for that sales, the leftover is $3 as a net income. It offers a measurement of a company's ability to withstand either higher expenses or low revenue. And the return on asset ratio expressed as income as a percentage of the total assets, right? So this measuring the earning power that ignores the specific source of financing. So basically, this $1 of assets, how much a dollar of net income you can generate. But this ratio does not care the resources that company has is coming from debt holder or equity holder, right? So it's just say that as all the resources there is, per $1 of resource, how much net income you generating. And when you look at the return on equity ratio, it's specifically asking for $1 of investment from the stockholders, how much net income generating, right? Okay, so now when we talk about the profitability analysis, we need to talk about the DuPont framework analysis, right? So in the DuPont framework provides analysis that breaks the return on equity ratio into 3 key components. So DuPont analysis is a very good way to look at what is the mechanism drives the high return on equity. And then it breaks down to the fundamental three components. One is the profitability of the business. Second is the efficiency of management of the assets or utility, the asset utilization efficiency. And last one is called the leverage of the business or financial leverage. It uses average total asset dividing total equity. And another way to presenting the DuPont formula is return on equity can be equals the return of the total asset, which is the profit margin multiple the asset turnover and then multiple the equity multiplier, we can call it, or people call it the leverage, right? So as we know that shareholders are often concerned how well the management using the equity to generating a profit, right? A closely watch the measure that capture this concern is return on equity, right? This measure, and it's calculating by net income dividing total equity, right? So in addition to the return on equity, investors also wanted to know how that return has been improved. And the DuPont framework providing a convenient basis for analysis that breaks the return on equity into three components. The profitability is the higher profit margin indicated companies can generating a lot of profit from each dollar of sales, right? And the activity measurement stands for the asset turnover, is actually measuring the higher asset turnover indicates a company uses its asset very efficiently, right? Whether you can efficiently using your asset turning into dollars of the sales. And the last one is a financial leverage. That one I want to talk a little bit more. Or you can, if it's equals the total asset dividing the equity. So it can be also interpreted as an equity multiplier. An equity multiplier indicates that relatively more companies' assets are being financed through debt rather than equity. So a company is more leveraged. We call it more leveraged, right? So in the chapter 3, we have talked about that already. Leverage can be providing, and then higher leverage can providing a more return on the company's equity holder. But we can also see from this equation, the second equation here, that equity multiplier, when it's greater than 1, it will produce return on equity higher than the return on assets. So basically, for example, return on assets is 0.2. When the equity multiplier is bigger than 1, say let's say 1.5, then the return on equity will be 0.3, right? So this means that higher leverage can help the equity holders in making higher return, right? But with all ratios analysis, there are trade-offs, right? If you can see that if the leverage is too high, right, the creditors will concerned about the potential default, right? If the leverage is really high, let's say 3.0, and then the creditors very concerned about the default risks of the debt, and then they will require much higher interest expenses, all right? So therefore, it will cause the return on assets, say instead of 0.1, it will, because net income can be decreased because the higher interest rate, so it can be dropped to 0.1. Hence that after this calculation, you will say still the return on equity is still 3. Or worse yet, if the equity ratio, the equity multiplier become 4, right? And the net income, the interest expenses is increased to extent that the net income dropped to 0.05. The return on asset is become only 5%. That means the return on equity is even lower, right? Become 0.2. So in other words, there's a trade-off between you are focusing on the because interest is recognized and the part of expenses, hence that the net income is reduced, so that at some point the benefits of having higher leverage multiplier offset by a lower profit margin. So in essence that part of the challenging of managing a company is to identify the combination of better how do you emphasize the profitability, or you can use leverage. How do you balance this to produce the highest return on equity as much as you can. Okay, so let's look at this example. So Harrington's pet supplies begin the year with an inventory balance of 220. At year-end, the inventory balance is 185,000. Cost of goods sold is 900,000. It's calculating inventory turnover ratio. So therefore, first of all, cost of goods sold dividing average inventory, right? So that would be 900,000 and dividing 220,000 plus 185,000, and then that will give us 4.44, and then average days in inventory will be 365 dividing 4.44, and that will be 82.21. So therefore we choose D. Okay, so last thing that we want to talk about is interim reporting, right? So we use a Home Depot as example. So interim reports are issued for the period less than 1 year. So typically a quarterly financial report, such as this one is a summarization of Home Depot's 2017 interim report. They reported first every quarter, so every 3 months, and then this is annual reports, right? And then they report the major income statement items such as net sales, gross profit, net income, and basic EPS, and the dilute EPS, right? So so when there is a financial statement covering period less than 1 year, we call it interim report. Companies registered with SEC, which include most public companies, must file, okay, quarterly report, right? And although there is no requirement to even though there's no requirement to do either is quarterly or monthly, but the majority of the time people do quarterly, right? And for accounting information to be useful to the decision makers, as we know that the interim report representing the qualitative characteristic of a timely information, right? So that's one of the objective of financial reports. In addition, quarterly reports provide investor and creditor with additional insight of the seasonality of the business, right? And as you can see, the sales of second quarter and third quarter is much higher than the first quarter and the fourth quarter of Home Depot. That because majority of home constructing activities are occurred during spring or summer times, right? And another thing about the shorter reporting period, some questions associated with estimation and allocation are magnified, right? So how do you, for example, certain expenses also benefit an entire year occurred in first quarter, and are you reporting everything in that specific quarter, or are you allocating across the year? This is a question that is raised in terms of interim reporting. And similarly, should a smaller company use a lower tax rate in earlier quarters and then use a much higher tax bracket for the later quarter because they break the tax brackets, right? And another thing about the shorter reporting period is that it can intensify unusual events such as material gain and losses. For example, the second quarter, there's a casual loss of about like the loss itself maybe only counts for 10% of based on the full year. But if you put it into the 1 quarter, it could be representing 40% of that quarter's income. So therefore, it could jeopardize people's understanding of the performance of that specific quarter. So therefore, there's an argument or debate between, in terms of interim reporting, between the discrete view versus integral view. So discrete view means that you are reporting this quarterly statement based on what happening as of that specific quarter, or you wanted to look at this quarter in terms of the whole year, right? And you have a more integral perspective in terms of reporting, interim reporting. So when we're doing interim reporting, how do we reporting revenue and expenses and unusual items? Regarding the revenue and expenses, most of the revenue and expenses has to be recognized using the same accounting method applicable to annual reporting, and most are recognized in the interim periods as they incur. What if an expenditure that can benefit more than just that period that it was happened, and then it should be allocated among the periods that benefit? And if income taxes expenses as each interim dates should be based on the estimation of effective tax rate of the whole year. So these two reporting standards is a more integral view, right? That if things that benefit over other period, although it's incurred in the specific quarters, you can still spread it out into other quarters. And then in terms of tax expenses, you have to take the tax position of effective tax rate as of that the whole year's gain to allocating the tax expenses. In terms of unusual items, such as discontinued operations should also be reported separately in the interim period in which they occur, and it's not allocated among individual quarters. And then in terms of earnings per share, how do we report earnings per share? Our quarterly earnings per share calculation follows the same procedure as annual calculation, based on the conditions actually existing during the particular interim period. And when you report the accounting changes, the reporting still should be retrospectively by applying changes to the prior financial statements. It's similar as annual report. And how do we disclose that changes? First of all, we need adjusting the income from continuing operation and adjusting net income, and also related the per share amounts for the post-changing interim period. In other words, recall that we are accounting for the changing of the accounting principle retrospectively, meaning that we have to recast the prior year's financial statements when we report those statements again in comparative form. So we make those statements appear as if the newly adopted accounting method has been used in the prior years. We are wanted to use the same way in the interim reporting. We retrospectively report a change made during an interim period in a similar fashion. So in the financial reports of the subsequent terms, interim reports, right? In the same year, we need to disclose how the changes, okay, that you made affect the income from continuing operation, affect the net income, affect the related per share amount for the post-changing interim period. Okay, and the interim reporting also have a minimum requirement as well. So you have to disclose sales, income taxes, and net income, also earning per share. Also, if there's a seasonal revenue cost expenses need highlighted, you have to disclose that as well. And the significant changes in estimation of income tax or discontinued operation of unusual items, contingencies, changing in accounting principles, information about the fair valuation of instruments and the method that assumption used in the estimated fair value, and the significant change in financial positions. Okay. And then lastly, we wanted to compare the International Financial Reporting Standards interim reporting versus US. as we already stated that the cost is supposed to accrued or deferred and then charged to each period that they benefit. In other words, in the interim report, the income are gonna be less volatile than under IFRS. This is because that under IFRS, it requires that the company apply the same accounting policies in the interim financial statements as it applies its annual report. Especially the costs that are expensed entirely in the period when each incur. In other words, if you have expenses happening in the second quarter, under the IFRS, it will ask you to entirely expense in that specific quarter. But under the US GAAP, if you consider that that expenses can be benefit to other profit, then you can spread it open, right? And also, so by doing that, you can see the US give the financial prepares a bit an opportunity to smooth the net income over different period, or put it another way, the income will be less volatile under the GAAP rather than under the IFRS reporting standards, right? And then another question is, how is the tax applied between the IFRS and GAAP? Under the GAAP, it says it has to count it based on the entire year's tax bracket, right? And it's also applied under IFRS as well. Okay, so we finished chapter 4. Basically, we went through the entire income statements and what is comprehensive income, right? And then we talk about the cash flow statement. And then between that, we talk about analysis, ratio analysis. And we also talk about the interim reporting, right? And then just to summarize, in the income statement, we say that there's two big category. One is the continuing operation, right? And then one is discontinued operation. And then adding these two up, we're getting a number called net income, right? And then in the continuing operation, we say that there's a core operation related and a non-core related. We call it tangentially related. So the core related is majorly we call it operating income, right? And the non-core related or incidental related stuff, we call it other income or expenses, right? And other than that, we also introduced a new concept. Is called other comprehensive income. And other comprehensive income is income related to non-owners, right? So in another word, it's not about it's beyond the scope of net income, and it's related to, say, currency translation gains, or unrealized fair value gain of the investments. So, and we say that this other comprehensive income can be accumulated other comprehensive income, which increasing the stockholders' equity as well, right? And then this need to be included in the statement of equity statement, right? And after that, we talk about the cash flow statement, and then we also revisit the ratio analysis. But the most new thing is the DuPont analysis, which is we find that the leverage, we call the equity multipliers, is gonna increasing multiple the return on asset is gonna calculating as a return on equity, and the equity multiplier is measure the percentage of the resources coming from the debt holder, right? So therefore, the higher this multiplier is, the more likely the return on equity is high. But there's a debate, there's a trade-off. when your leverage is too high, the debt holder is charging too much interest, hence it will drive your return on asset low, hence that your return on equity is still going to be decreasing, right? So we give an example. And the last thing is interim reporting. Interim reporting, the most theoretical and conceptual is that are we reporting the interim based on the integral perspective, or are we reporting it as a discrete period? If you look at it as a discrete period, a lot of expenses has to be recognized immediately in a specific period. But if you consider an integral perspective, means that you wanted to able to match the annual report results equals the first quarter and the second quarter and third quarter and fourth quarter add up. So if this is the purpose of reporting interim to producing timely information, but that information itself can be added back matching to the annual report, then there's a different way of doing that. So therefore, we believe that the GAAP is more integral perspective, and IFRS may be more focused on the discrete perspective. So okay, this is gonna be the chapter 4. So I hope you enjoyed the video, and I will see you guys in chapter 5.